Let's explore this variance problem. We've got Becton Labs Inc., and they produce various chemical compounds for industrial use. One compound, called Fludex, is prepared using an elaborate distilling process. The company has developed standard cost for 1 unit of Fludex as follows. And you see the information in front of you. Direct materials, 2.5 ounces are used, cost $20. That's the standard price per ounce. So 2.5 times 20 gives us a standard cost of $50. Direct labor requires 1.4 hours, and the standard price for our direct labor is $12.50 per hour, so that gives us a standard cost of $17.5 for 1 unit of Fludex. Variable manufacturing overhead is also known. It's given at 1.4 hours. And it's applied at $3.5 per direct labor hour. Okay, so that cost becomes $4.90, so that we know there's a standard cost of $72.40. Now, during November, they tell us the information you see to the right of my mouse here. Material purchased was 12,000 ounces at a cost of $225,000. There was no beginning inventory, but at the end of the month, 25 ounces remained in ending inventory. Note C says the company employs 35 lab technicians to work on the production of Fludex, and during November they worked an average of 160 hours at an average rate of $12 per hour. Variable manufacturing overhead is assigned to Fludex on the basis of direct labor hours. Now we know that from the way the information was presented in the standard, and variable manufacturing overhead cost came to $18,200 during November. They made 3,750 good units of Fludex. So the first requirement is for direct materials, and we're asked to compute the price and quantity variances. Okay, and here you see the solution for the material price and quantity variances. Again, what we do is we have one column that's actual times actual. Actual quantity of input at the actual price, and on the far right it's always standard at standard. The standard quantity allowed for the output at the standard price. They gave us $225,000 as the total spending for materials. So that's our actual quantity times actual price. And if we wanted to compute the standard allowed, it's 9,375 ounces. Well, how did we come up with that? They made 3,750 good units. The standard called for 2.5 ounces per unit. That's where the 9,375 comes from. Okay, and they gave us a standard price of $20 per ounce. So if we take the 9,375 times the 20, that's $187.5. Now if we compare the $225,000 of actual material cost to the $187, we can compute the total material variance, the difference between the 225 and the 187. But there's a twist, and the twist is you have to think about the difference between what was purchased and what remained in inventory. So if you look at that blindly, you're going to get it wrong. Instead, you've got to calculate items separately. So let's look at the price variance. 12,000 ounces times $20. Well, where did the 12,000 come from? It came from right here. When we calculate price variance, we're not concerned with when it's manufactured. When we calculate material price variance, we calculate it based on when it was purchased. So we purchased 12,000 at $20 12,000 at $18.75 per ounce. Well, how do we know that? Because we knew total spending was $225, and they told us we purchased 12,000 ounces. There was nothing available in it in beginning. So 225 divided by the 12,000 gets us the $18.75. So now that we know that we've got $18.75 price that's different from the 20 standard price, we can calculate that price variance. We can either compare the 225 to the 12,000 times the 20, or you could take the 12,000 times the difference between the $18.75 and the $20. You'll come up with the same 15,000 price variance. Okay? Then when we compute the quantity variance, we have to consider what was used in production. Now, we already know that standard was 3,750 good units times 2.5 ounces. So the standard called for 9,375. But what was actually used? We flip back here and we say we purchased 12,000, there was no beginning, but 2,500 remained in ending inventory. So what was actually used was the 12,000 less the 2,500. All right? That's how we come up with the 9,500 ounces used. So 9,500 times 20 gives us 190,000, and that's what we're going to use to compare to the 187.5, and that gives us a quantity variance of 2,500. Okay, now I've changed the question at the bottom. Now we're going to tackle question 2, which says for direct labor, compute the rate and efficiency variances. All right. And here's the approach you use. Again, left side is always actual times actual. The actual hours times the actual rate. The right side is always standard times standard. The standard hours allowed for the output at the standard rate. All right, so we worked 5,600 hours at an actual cost of $12 per hour. Well, how did we come up with that? They told us there was 35 technicians. They worked 160 hours per technician. That's 5,600 hours. Okay, and that information came from here. 35 hours, 160 hours per technician, average rate of $12 per hour. And keep in mind that the standard called for 1.4 hours at $12.50 per hour. So we can jump to the far side and figure out that $12.50 per hour is the right amount. And we got to remember that there's that 1.4 hours. So the standard called for 5,250 hours. That would be 3,750 technician used times the 1.4 hours per technician, right? And 3,750 was the number of units we produced. So that gives us 5,250 hours. All right, now all we have to do is, and sometimes you can use this little technique, you slide the actual hours to the middle and you slide the standard rate to the middle to do the middle column. But if you want to think about it another way, you can think about it as actual hours times the difference in the rates. So 5,600 times the difference between 12 and 12.50 gets you 2,800, and it's favorable because our cost was $12 per hour and the standard called for 12.50. Now, if you want to do the column approach, like what's presented here, you use 5,600 actual hours times the standard rate, and it says that the actual hours of input at the standard rate should have been 70,000. That's more than what we incurred. That's why we're favorable. 70,000 less than 67.2 gets us 2,800. Now, over on the far side, we then have to compare the 70,000, that middle ground, which is actual hours of input at the standard rate, versus the standard hours allowed at the standard rate. And that difference is 4,375. Now, since the column on the left is greater than the column on the right, and the column on the left uses actual hours, we know this is unfavorable. The other way of thinking about that is you could take the standard rate, 12.50, times the difference between the hours. So 12.50 times the difference between 5,600 hours and 5,250 would also get you the 4,375 unfavorable variance. When we add these two together, you get an unfavorable variance of 1,575. Now again, I want to say in my personal experience, we would call this the total labor variance. What I've seen in my experience is that the efficiency variance was also the same thing as the spending variance. Rate variance was called a rate variance. So I tended to call this total labor variance. Efficiency variance sometimes is called the labor spending variance. Okay? That's how you solve the second requirement on this problem. Okay, now back to the problem. The third requirement says compute the variable overhead rate and efficiency variances. So we're essentially going to repeat this process, but we need to recognize that variable manufacturing overhead is applied based on direct labor hours. Okay, so here you see the solution to part 3. Again, actual hours at actual rate, and on the far right is standard hours at standard rate. Well, actual hours at actual rate is 18,200. Okay, the 18,200 is given in the information. So they would probably look at the general ledger and see what was spent during the month, what was applied to various manufacturing overhead accounts. That's how they came up with the 18,200. All right, if we jump to the far right side, we see that the standard hours allowed for this level of output was 5,250. How did we come up with that? 3,750 of units were produced at 1.4 hours per unit, so that's 5,250. The standard rate is 350 per hour. And the 350 per hour was developed as part of their process of developing the standards, probably right before the start of the year. Okay, so 5,250, 350 tells us 18,375. If we compare the 18,375 to the 18,002, this is the total overhead variance. And again, in my experience, this is called total overhead. Efficiency variance and spending were used interchangeably. Okay? But once we have that, we can create the middle ground again. We use the 5,600 hours, which would be the actual hours times the standard rate to come up with a middle ground. Compare the actual spending, the actual, well, yeah, that's what I would call it, the actual spending, what you really spent your money on, versus for manufacturing overhead, versus this middle ground, the actual hours of input at the standard rate. We come up with 19.6, and the difference is the rate variance. Now, you may want to think about it as just 5,600 times the difference between the actual rate and the standard rate. But that's harder to produce when they give you a lump sum dollar amount. Okay, that gets you your rate variance. Now, if we compare the middle ground, middle column, the actual hours at input times the standard rate times the standard hours allowed for that level of input at the standard rate, we compute the efficiency variance. And here again, you can just take if you want to think about it this way, take the standard rate, which is 350 per hour, times the difference between actual hours used and standard hours. Okay? And that's how you compute the various variances relating to variable manufacturing overhead.